and welcome to China Perspectives, a podcast on the latest economic and credit market developments in China, featuring experts from both within and outside of Fitch Ratings. As the first international credit rating agency to set up an office in China, Fitch offers the unparalleled experience and insights into the market.
Welcome to China Perspectives podcast. My name is Ying Wang, Head of North Asia Industrials, Property, Consumer, and Utilities at Fitch Ratings. I'm joined today by Kathy Chow, Senior Director and Head of the Greater China Consumer Team, and Kelvin Ho, Director and Senior China TMT Sector Analyst. We're going to discuss a very popular topic in China's e-commerce world today, which is instant retail. China's e-commerce industry has always been highly competitive, even though a handful of leading platforms command a higher share of the market than in most other industries in China. Over the past decade, the space has been marked by repeated, hard-fought price wars across segments and formats. The latest battleground is instant retail, originating in food delivery and now rapidly expanding into broader offline local commerce. To start off, Kathy, could you please give us a quick recap of how this round of price war in food delivery and more broadly instant retail started in the first place? And what does the competitive landscape look like now?
Sure, thanks, Ying. So, just to give a quick recap, starting in April of this year, JD.com started entering into food delivery. And as with many platforms, when you enter food delivery, you have to offer very high subsidies in order to attract users to your platform. Then Alibaba, which was also in the market, it has always been in the market in food delivery under their platform called Ele.me. They also joined the price war as well. And so you see this very high subsidy environment offering to users in order to attract different customers to their platforms. So the competition of food delivery affected all categories, but the most heavy subsidies were focused on lower price items like coffee and tea. So we've seen some volatility in terms of volume. Market share, and we expect that this would have intensified into the third quarter. Now, we looked at news reports and also based on anecdotal discussions with people within China. So in September and October, the subsidies should have been lowering, and so we should have seen the peak of this subsidy cycle starting to moderate.
Thank you, Kathy. Well, we know that Meituan has been the leader in food delivery. So, how do you view Meituan's strategy to defend its leadership? What sort of opportunities and challenges does Meituan face now?
In terms of Meituan's strategy to defend its market leadership, we think that they may need to continue to offer subsidies as with the rest of the industry, but we don't think they need to match necessarily because they do have leadership advantages such as efficiency, they have lower unit costs thanks to larger scale, and so that is why we think that Meituan will maintain their leadership in food delivery. They may not be as dominant as the over 70% market share that they had prior to this price war, but still a strong enough position where they can benefit from economies of scale. And they do maintain a lot of advantages that they've built up over a long period. Key advantages like its extensive merchant network, reliable delivery capabilities, deep local expertise, and strong financial flexibility. And so we think that these will take time for other players to try to build up. I'll leave it to Kelvin to talk later about Alibaba's prospects, but we think that JD.com might end up be focused on specific categories or in specific regions since it is difficult for them to build up such a big platform relative to the two dominant players in food delivery. In terms of instant shopping, this represents a huge opportunity. It's a high growth industry and the user growth is also growing as well. And so there's a much broader pie that can support multiple players within the industry. So we think that this represents an opportunity for Meituan, as it has over the past couple of years that they have been building up this business. I think in terms of challenges, they do need to figure out their addressable market segment because the product categories can be much broader than food delivery, for instance, and they are less likely experienced in supply chain areas like e-commerce platforms like Alibaba, for instance. So they do need to think about balancing cost against operating efficiency and also selecting those time-sensitive categories that would benefit most from the instant retail operating model.
Now, turning over to you, Calvin, I think it is becoming pretty clear that Alibaba is posing a bigger threat than JD.com to Meituan's leadership in food delivery and instant retail. Do you think Alibaba has a competitive strategy to succeed in this war eventually? And what sort of challenges does Alibaba face?
Okay, Alibaba's launch of Taobao instant commerce, coupled with the consolidation of the brands and merchants into the instant channel, is designed to defend its core market share while capturing a meaningful share of China's instant commerce market. The management is targeting an incremental GMV of 1 trillion renminbi over the next 3 years. As we see it, there are tangible cross-platform synergy for Alibaba from integrating Eleme's delivery network with Taobao's commerce traffic. High-frequency food delivery users are converting into broader instant retail shoppers, and earlier operations data suggests customer awareness and engagement are moving in the right direction. Apart from traffic, share supply chains, overlapping user base, and unified membership benefits are reinforcing Taobao's app's market leadership, making cross-selling more natural, which should help sustaining GMV growth over time. In terms of key challenges, just to name a few: number one, intense competition from Meituan; number two, potential cannibalization of Taobao's core marketplace economics; and number three, sustaining user retention beyond the initial promotions.
Thank you, Calvin. Coming back to Meituan, Kathy, Fitch revised Meituan's outlook to stable from positive and affirmed the triple B plus rating after its second quarter results. Could you please explain the rationale for this outlook change and also talk about the potential upside and downside scenarios for the rating?
Sure. The outlook revision mainly accounted for the ongoing uncertainty from market competition going on. We think that this should persist, bring a greater degree of uncertainty in terms of EBITDA generation. So we expect that part of the rationale, our thesis is that the market leadership for Meituan will be maintained in food delivery and that they will make progress in instant shopping. But I think in the medium term, profitability could be volatile or structurally lower than we had previously expected due to the higher degree of competition. So we think that the coming quarters, the free cash flow could be volatile, but that in 2026, it should revert back to positive. So in terms of the upside case, we think that it's less likely in the medium term. We probably need to see a longer track record of consistency in EBITDA, which is difficult under the current market landscape with the degree of competition, with the uncertainty, for instance. And so I think that in the near term, Meituan is ratings is probably more difficult in terms of the upside rating trajectory. On the downside, we expect that if the competitive environment intensifies for longer than we expect, either subsidies continue to a greater degree or there's sustained market share losses for Meituan, leading to less efficient operations overall. This could result in structurally lower EBITDA for longer. And then the company is also investing in overseas markets, and they have adjusted their overseas expansion strategy in light of the price war this year. So they have curbed back their investments on this front. But generally, I think that an inability to return to positive free cash flow by 2026, past the peak area of the price war, if there's, for instance, a higher degree of competition that leads to structurally lower profitability for longer or higher investments that lead to negative free cash flow in 2026, for instance, then that would also lead us to consider taking negative rating action.
Turning to you, Calvin, let's talk about Alibaba. We know Alibaba has deep pockets to spend and compete in e-commerce, but at the same time, its AI investments remain very high. How do you see its profitability and free cash flow trajectory in the next 12 to 24 months?
I think in the near term, profitability and cash generation will be under clear pressure because Alibaba step up spending despite narrowing losses in international commerce. We are expecting Alibaba's EBITDA to drop 13% year-on-year and FCF margin to compress materially in FY26. This reflects a trade-off by accepting near-term margin dilution to build long-term growth. We are expecting price competition to moderate over the next 6 to 12 months. This should be able to support a tentative profitability rebound in FY27 because subsidies, rationalization, and operating efficiency flow through. However, a quick and full return to previous margin level is not our assumption, given structurally intense e-commerce competition and leading platforms' continual emphasis on scale and ecosystem depth over maximizing near-term profitability.
Coming to the end of our podcast, Kathy and Kelvin, can both of you share your perspectives on how this war may potentially end, if it will end at all? Let's start with you, Kathy.
Sure. Well, as I said previously, we have seen price wars in the past, and then these have been relatively short-lived. They haven't tended to last more than 1 year because structurally, many of the players, even though the players in this case are in a net cash position, they cannot sustain this degree of losses for that long, nor is it desirable to. And so we expect that the impact of the price war on profitability should moderate in the coming quarters. Third quarter is our current assumption for the peak, but I think fourth quarter is probably the key inflection point to see if there has been a moderation or not. And so we think that a degree of competition will persist in the medium term, but that this level of losses that we've seen based on subsidies, for instance, in the second and third quarter of this year, is unlikely to persist. So they could be structurally lower EBITDA profitability for, let's say, Meituan compared to what we saw last year in 2024, but that they can still maintain a reasonable degree of profitability and a high degree of operating efficiency as they continue to scale up in terms of taking advantage of growth within the market. I'll pass it over to Kelvin now.
Okay, so I think the price war is unlikely to end suddenly if the broader e-commerce competition is the guide. Then the instant commerce may move through 3 stages. First, the land grab, and second, the rationalization, and third, the ecosystem integration. I mean, maybe we are currently at the tail end of land grab with rationalization about to begin in the next 6 months or so. A full cycle could reasonably take about 3 years. In terms of competitive landscape, we do not assume a winner-take-all outcome. Deep pocket platforms can sustain competition. This points to coexistence rather than consolidation to a single leader. Platform-led players will focus on breadth and speed, while operator-led rivals will focus on supply chain and guarantee service quality. Maybe a likely scenario is that the market will be maturing towards a layered model with tier service levels and subsegments. Speed will remain a hygiene factor, but advantage may increasingly come from AI-enhanced discovery, personalization, social conversion, and efficient local fulfillment.
Thank you so much, Kathy and Kelvin, for sharing your great insight into this interesting sector. China's e-commerce is a highly topical sector, and it will be interesting to see how instant retail competition reshapes this sector. I look forward to our next episode on this topic. That's all we have for today's podcast.
You've been listening to Fitch Ratings China Perspectives podcast. To learn more about our ratings and research on China, visit us at fitchratings.com. Subscribe to China Perspectives wherever you get your podcasts.